Hi everyone, welcome to Bright Labs. Today I'm going to take you to a very important topic in AP Macroeconomics, monetary policy. We'll dive deep into what it is, how it works, and why it matters. Let's get started. First, today's presentation is called Monetary Policy, Managing the Money Supply in the Economy. My goal is to explain how the Federal Reserve uses monetary policy tools to steer the economy towards stability and growth. So first here, what is the monetary policy? So monetary policy refers to the actions taken by a country's central bank, in our case the Federal Reserve, to control the money supply and influence interest rates. These actions aim to achieve broader economic goals like stable prices, low unemployment, and steady economic growth. Next, let's look at the role of the Federal Reserve, often just called the Fed. The Fed is the central bank of the United States. It's independent from the federal government, meaning politicians can't directly tell it what to do. Its main responsibility is to conduct monetary policy as well as regulate banks and ensure financial system stability. Now, what are the main goals of monetary policy? First, price stability, keeping inflation low and predictable. Second, maximum sustainable employment, meaning as many people employed as possible without causing inflation. And third, moderate long-term interest rates, keeping borrowing costs reasonable over time. How does the Fed actually do this? They have three main tools of monetary policy: open market operations, discount rate, reserve requirements, and each tool influences the amount of money circulating in the economy. First up, there is open market operations, or OMOs. This is when the Fed buys or sells government bonds. When the Fed buys bonds, it pumps money into the banking system, increasing the money supply. When the Fed sells bonds, it pulls money out, decreasing the money supply. The second tool is the discount rate. This is the interest rate that banks pay when they borrow money directly from the Federal Reserve. Lowering the discount rate encourages banks to borrow more, expanding the money supply. Raising the discount rate discourages borrowing, contracting the money supply. The third tool is reserve requirements. This is the percentage of deposits that banks must keep on hand and not loan out. Lowering reserve requirements allows banks to lend more money, increasing the money supply. Raising them restricts lending, tightening the money supply. Now let's discuss expansionary monetary policy. This is used during recessions or slowdowns. The Fed wants to increase the money supply, lower interest rates, and encourage more borrowing and spending. More money in the economy boosts the aggregate demand, helping to push the economy back toward full employment. On the flip side, we have contractionary monetary policy. This is used when inflation is too high. The Fed decreases the money supply, raises interest rates, and makes borrowing and spending more expensive. This cools down economic activity and helps bring inflation back under control. Now, how does monetary policy affect aggregate demand? Lower interest rates make loans cheaper, so consumers spend more and businesses invest more, shifting aggregate demand right. Higher interest rates have the opposite effect, shifting aggregate demand left. It's also important to distinguish monetary policy from fiscal policy. Monetary policy involves the Fed adjusting the money supply and interest rates. Fiscal policy involves Congress adjusting government spending and taxes. Both can stabilize the economy, but they work in different ways and through different institutions. There are definite strengths to using monetary policy. The Fed can act quickly compared to Congress. It avoids political battles since it's independent, and it's particularly effective at controlling inflation. However, there are also weaknesses. There are time lags. It takes time for the Fed to recognize a problem, decide on a policy, and for that policy to take effect. In very deep recessions, lowering interest rates might not work because people are too afraid to borrow. This is called a liquidity trap. Finally, monetary policy is better at controlling inflation than at stimulating real economic output. In conclusion, monetary policy is absolutely crucial for maintaining economic stability. The Federal Reserve must carefully balance between encouraging growth and controlling inflation. Understanding how monetary policy works not only helps in AP macroeconomics, but also in understanding real-world events from recessions to booms. That's it. Thank you for watching. Leave any questions you have in the comments, subscribe, and I'll see you in the next video, and good luck with your studies.